Today we are going to discuss about risk and Basel. Most probably Basel next week, but I will be starting risk today, right? We need to take a risk whenever we have to do something, whether it is in your life or in your professional career. You need to take a risk, right? We will learn what is risk, categories of risk, some categories, and introduction to Basel, which is the second part of the lecture. Can someone tell me what is the difference between these two? Which one out of these two, which one is risk? This is bungee jumping and this is a tsunami, right? Think. Which one is risk? Basically, this is risk and this is uncertainty. Why this is risk? Risk should be able to quantify. We know when 100 people jump, maybe one lucky guy will go up, all others will remain in this world. Right? Similarly, when you are giving uh, housing loans, 97 people, 98 people will pay. But maybe a 1%, 2%, 3% will go bad. So we can quantify. The damage, when we can quantify, it is called risk. Uncertainty, like when tsunami came last time, we lost 60,000, right? If it comes next time, we don't know how much. So we can't just try and wait. It is an uncertainty that we don't know whether we will lose anyone or we will lose a million people. It is uncertainty. But to become a damage to a risk, you should be able to quantify. Right? That is the difference between risk and the uncertainty. When it comes to financial institutions, we have the risk structure. Right? We have our board of directors. Within the board of directors, we have different committees. But the main two committees are board risk committee and board audit committee. These are the watchdogs of the bank, financial institution. Why? Because we are lending others money. It is not our money we are lending. So everything has to be regulated, well looked after. Right? So these two committees need to be headed by two directors who are independent and non-executive. What do you mean by independent and what do you mean by non-executive? Executive means the salary is paid to this director. So they are the person who is responsible for the growth to show the figures. If that director is responsible, then he is executive director. Like our CEOs, our managing directors, MDs are executive directors because they are paid a salary, not a remuneration, and they have a vested interest to see the growth of the bank, profitability of the bank, and operation levels of the bank. So they have a vested interest on the figures. Therefore, they are not eligible to sit on the chair this committee. That is executive director. Independent. A director who does not have shares and he is a director because of his shareholding, they are non-independent directors. The director who is there on the board as a representation of an independent body like Central Bank of Sri Lanka, Government of Sri Lanka. They are the directors who are independent. They don't have a vested interest to see the growth of the bank or performance of the bank. Independent and non-executive. Why? These two committees are the most critical committees among all the subcommittees, board subcommittees. Right? So board risk committee, which looks after the three main risks in a bank, which is credit risk, market risk, and operation risk. Credit risk is looked after by credit committee, board credit committee. Operation risk is looked after by operation risk committee, whereas the market risk will be looked after by ALCO or asset and liability committee. Right? I will go little deep and detail into these risks shortly. Right? So that is the first part, board risk committee. Then we have the policeman, is the board audit committee. Right? They are the committee which looked after the bank following of laid down procedures, no violations. That is the audit department's function. Right? So when we have risk, we have four ways of tackling it. We can just avoid risk, don't take in risk, don't give TODs, no clean facilities. Then accept, yes, we know that there is a risk, but based on the return we have, we will accept it. And knowing the risk factors, we are accepting the risk. Then we try to reduce the risk, like take a mortgage, structure the facility, like that, we will try to reduce. Like whenever you are giving a OD, take some PDCs. So then it is self-liquidating. Always check for the PDCs. Check the check return ratios. Like that, you try to reduce the risk and accept it. Avoid, accept, reduce. Then you try to transfer the risk to someone else. Like the most common and the most familiar example in Sri Lanka is insurance. Right? We try to take a portfolio insurance. Why? If a customer dies, we don't have a problem. We will claim the insurance and we will cover our money. We take a fire insurance. In case of a fire disaster, we will cover our loan. So we don't have to tell our depositor no money. So we transfer the risk to a fire insurance company. In the world, we have derivatives through which we can transfer interest rate risk, default risk, like that, different risks we can transfer. But in Sri Lanka, we don't have those derivatives. So the easiest and the most familiar example I can give you is the insurance. So risk can be tackled on these four ways: avoid, accept, reduce, and transfer. So let's come to the actual introduction of risk. Risk is the exposure to present or future loss of profit and or capital. Is the exposure to present or future loss of profit and or capital, both. It can be profit, it can be capital. Right? It could be due to the faulty analysis of the current circumstances or probabilities or future changes of Wesley environment. What does this mean? Risk is the exposure to loss. It can be loss of our money, it can be loss of our profit, it can be loss of our cash flows. right? It is due to current circumstances, faulty analysis of current circumstances. We have 5 C's of credit, character. We have wrongly identified the person to be given. We identify a willful defaulter as a good person. Then it is a faulty analysis of current circumstances. Almost bankruptcy filing company. We have done the financial evaluation wrong. We have given funding. Customer is in a bad industry condition, but still you don't understand that. You did not predict or did not analyze properly the industry. Then we give a loan and the industry collapses. Now you can't do anything. Right? It is a fault analysis of current circumstances. Then we learned about Presley environment, which is the macro analysis. Right? Political, change in the political scenarios. Right? We give a loan today, after a few years, regime change, they stop the project. So, loan will be bad. Right? It can be economical situation. Economic. Like tourism. When you don't have money on the tourist destinations, like when there is a recession or when the people who is traveling does not have enough money, then it will affect the tourism industries in other countries. Economic related. Like even us, when our purchasing power goes down, industries get hit. Social, society, sociological, right? You try to fund a butchery, it is not a good business as per the society, right? So those things, technological. So any changes in the technology in the future will affect. Mobile industry, it is rapidly changing. So you invest today, but due to the technological change, this company collapsed. Then we have an issue. Then legal matters, right? In the future, legal matters change, therefore the industry affected. Environmental. This is the carbon. We all talk about global heating, waste management, carbon emission, all those things. So in the future, there is a change, and because of that, our business get hit. So any change in the Presley environment, because of that, we have a loss. Right? That is the future changes of Presley, because we look at the current scenario of these 5 factors, and after 2 years, it changes. As a result, we get a loss of profit to capital. Future loss of profit to capital under that set. Then risk management is the process of measuring or assessing the actual or potential danger of a particular situation and taking necessary actions to minimize the effect. Risk management is the process of measuring or assessing actual or the potential danger of a particular situation and taking the necessary actions to minimize the effect. We need to measure. Then we know what is the potential damage. Then take necessary actions to minimize the effect. Right? It is a cycle again. Assess the risk, plan the policies, implement monitor and evaluate. So it is a circle. So you continue always. Risk management is not just one-time process. It is a process of continuous process of management, right? You give a loan, follow up. If the customer is not doing it right, you change the governance, conditions, continue, and you follow up again, right? So this is the risk management. Any questions? Any question? Okay. Right? In lending, we have basically, we talk about financial risk, which is subdivided into borrower's risk and transactional risk, right? Borrower's risk, that is the borrower, the risk relating to a borrower. That can be subdivided into three parts. Industry economic risk, which is like any industry, inflation. Because of the inflation, this industry get a hit. Change in forex, right? Now dollar rates fluctuates. Imports, we have an issue now. So that is the industry economic risk. Nothing to do with a particular industry, but it is something to do with the entire economy. Then industry structure risk. There we talk about the industry risk. Polluting industries, high energy consuming industries, high import dependent industries. Risk intended to industry. If you are going to finance a project where the raw material is purely imported, you will have a problem in the continuation. Why? It is very difficult to finance import these days. Imports has been restricted very much. No dollars. Every day we try to manage our dollars. We don't have dollars to give it to importers. Right? So industry structure risk, operating risk, that can be frauds, errors, all those things. The risk relating to borrower. When we are lending, we have to look at these three parts. Borrower's risk, which covers under these three items, and transaction risk, which is inherited in lending. We give wrong facility. We give wrong repayment period. Terms and conditions, wrong. We have taken the second way, which is the collateral, wrong. Right? We have gone and taken a mortgage on a land which does not belong to this field, fraudulently. We have done a mistake. Right? So, above result, the financial risk in lending. When we are lending, we have these two risks, borrower's risk and even the product risk or transactional risk. Risk can be sliced and diced anyway. These are some of the risks we mainly face with: credit risk, market risk, operational risk, reputational, liquidity, legal, regulatory. I will discuss the first three little deep. First one more, but other two also I will take you through. Reputation risk. What do you mean by reputational risk? Reputation of the bank if you get into money laundering, it creates two risks. Reputation risk, that is, oh God, this is a bad bank. They are all taking all black money. So good people will not associate with that kind of a bank. Or you, even your investors, oh, this is not a good place to invest. They will leave out. So we have an issue there. Like, why do we keep very small amount of cash in our branches? Why? Is it the cost? No, it is not the cost. It is the reputation we are worried about. Why? Whenever a robbery happens, if you lose 500,000 rupees or 50 million rupees, which one keep in your mind? You will remember for long. It is the 50 million. See, look at whatever the bank robberies happen during last few years, we lost 5 million, we lost 500,000, small amount. We just talk for a few days, then you forget. Right? But if you lose a huge amount, then you continue to remember that. That is a bad reputation. Depositors will be careful when they are coming to deposit. So that is a bad reputation. Then we talk about liquidity. What happened to Golden Key? They didn't have enough money to pay the depositors. It's the liquidity. Liquid cash we need. What is our liquidity ratio of the banking industry? It is 20% of your liability book. That means if 20% of your customers suddenly comes to the bank to withdraw, still you should be able to pay them off. Golden Key, that happened. Suddenly everyone rushed to get their money. Golden Key couldn't pay. Therefore, that collapsed. 2008, when the global crisis happened, what happened? Was it bad loans? Yes, it is to deal with bad loans, but it triggers not from bad loans. It triggers from liquidity, because UK Bank, Northern Rock Bank, there was a mismatch between their asset and liability maturities. One journalist identified it and published an article. Because of that, UK population, general public, they were afraid that they will not get their money back. They rushed to collect their money. Because of that, even after Bank of London, that is the central bank there, came and guaranteed the repayment, still people wanted their money. Because of that, this liquidity issue, bank collapsed within 4 days. 4 working days, bank collapsed. That collapse continued to all the way to US, to everywhere. Because we are linked together. Right? That is liquidity. Then legal. You say how many? Legal and reputation. Like you do a wrong operation, then central bank will fine. How many banks are getting fined? Right? So we have different risks. These are the three main risks associated with banking sector: market risk, credit risk, and operation risk. Our subject revolves around this. but I will take you through market risk and operation risk as well, little deep. What is market risk? Any risk arising from interest rates, commodity prices, currency and foreign currency and equity is called market risk. Any risk arising from changes in interest rate, commodity prices, currency fluctuations and equity fluctuation, that is called market risk, and it will be looked after by ALCO, Asset and Liability Committee. What is interest rate risk? Like, we lend long term at a fixed rate, right? But our lending is backed by short term rates. You lend at 7% for 10 years fixed. Now, short term rates are going up, deposit rates are going up. As a result, what happens? Our margins comes down. So this is to do with our interest rates, right? Fluctuation in interest rate, the risk arising from fluctuation in interest rates. Then what do you mean by commodity prices? The easiest and the most familiar example I can give you is the gold market, right? What is the price of gold today? 102 rupees. That is the latest I heard. 102 rupees. Sorry, 102,000 rupees per sovereign. Right? 5 years ago, the same thing happened. We went up to 60,000 sovereign, and gold market international prices dropped. So our gold market collapsed. Price came down to 23,000 rupees. I can remember that. So all the banks got hit on pawning product. Now again it is going up. Another bubble, it may collapse. May not collapse, may collapse. And so risk arising from changes in price. In Sri Lanka, this is the only commodity price we deal with. But in the world, we have crude oil, silver, copper, even butter and cheese, they deal on derivatives. Right? So any changes due to these commodity price changes will affect our profits over the capital. Then currency risk. Why? What is happening today? Why don't we have dollars? See, exporters are not selling dollars. So our supply of dollars to the bank are low. Why are not they supplying? They are not converting because they are waiting for the exchange rate to go up. Right? Then bank has to go and borrow from the central bank. Bank has exposure now. $10 million. Suddenly price dollar flows, each and every bank will get a hit. So this change difference creates a risk to the bank. Right? If we say, okay, today bank has borrowed $10 million from central bank because they don't have export proceeds coming in, but they have to finance their loans, they have to repay their loans, they have to honor their import bills, so they go and borrow from central bank. Right? Tomorrow, today we are borrowing at what? 203. Tomorrow central bank decide, okay, we are devaluing. Right? So tomorrow the price would be 213 rupees, 10 rupee devaluation, 5%. $10 million into 10 rupees. 100 million rupee hit to the bank. That is a currency risk. Then equity risk. We deal with equity market or stock exchange. All the banks, we are investing our excess cash or we invest for trading. Right? So we go and invest, suddenly share market crashes. So it will affect our profitability. So any risk arising from interest rate, commodity prices, currency and equity is called market risk. Then I'll skip the credit risk. I'll go to operational risk. What is operational risk? Any risk arising from people, procedures, processes and systems. That is called operational risk. It is something to do with us. You are doing a money transfer. You type the account number, instead of 01, you type 10. Money goes to someone else's account. Right? That person takes out the money and vanishes. You don't have a way of collecting. Now it is operational because it was an error from people. Once it happened, we wanted to transfer some money to Jaffna branch. Mistakenly it went to Aturugiriya branch. That customer took that 50,000 and vanished. We had to go behind him for almost a year to get that money back. So it is a mistake, human error happened. Right? Some cyber attack, system crash. Because of that, we lose. Right? Even when you walk, you fell and you break your leg, it is a risk to the bank. The procedures we have laid down is not adequate. Therefore, the bank gets a hit. So that is a procedural risk. So any risk relating to people, processes, procedures and systems is called operational risk. That will be looked after by operational risk committee. Then we go to our main topic, which is credit risk. If this handout is a detailed handout, so if you go through the handout, you will see the details of the risk. I'm not going to take you through everything. I'm doing the operation credit risk part only, right? Any questions up to this point? Can I proceed? Is this clear? Good, bad, ugly? Okay. Hope others are the same, or anyone wants any clarifications? Right. Right. Credit risk due to and uncertainty in counterparties, the borrowers, the other party, ability to meet its obligation in accordance with agreed upon terms. Like credit risk is, in very, very layman terms, will I get my money back? Will I get my money back? For a depositor, they come and deposit their money with the bank. Always they have an issue. Say, can I get my money back? They deposit for 1 year. Will I get my money after 1 year? That risk prevails. Right? What happened on Golden Key again? Depositors deposited, but they couldn't get the money. What happened to Swarna Mahal? They couldn't get the money. What happened to ETI? Couldn't get the money. What happened to guarantee company? Yeah, what was it? Security, selling for securities and guarantees. They couldn't get the money. Right? So like that, will I get my money back for depositor? Similarly, when a customer takes a loan from a bank run into the credit risk thing, can I collect my loan back? When a distributor distributes something, whenever they give credit, they run into the risk of, will I get my money? Even you and me, will I get our salary? That's a credit risk. Right? So risk due to an uncertainty in counterparties' ability to meet its obligation in accordance with agreed upon terms. In detail, credit risk is an investor's risk of loss arising from a borrower who does not make payments as promised. Right? So that is called credit risk. The below part I just explained. Loan, you will not get your money. Right? Trade invoices, wages, bank won't refund. This is what I just explained. So credit risk comes from two parts. Firstly, it is the credit default risk or transactional risk, right? That is what will my customer repay. Okay. Bank consider that the obligo is unlikely to pay its credit obligations in full. When we consider our borrower is very unlikely to pay our loans back. Whenever a bank consider customer will not pay the bank or any facility is more than 90 days in arrears. Why 90 days? It is the NPL threshold. Whenever a bank consider the obligo will not pay as agreed in full, or when the facility is 90 days arrears, we take credit risk. We have customers who are always making payment 1 day, 2 day, 1 month, 1.5 months delay. That is not credit risk. That is called liquidity risk. Why? We plan our cash flows. We say, okay, this month we are getting 500 million back as our repayment. But we get only 300 million. So we don't have that 200 billion you need to pay for the depositors, or you need to pay for your own loans. You don't have that money. Right? So you need to find a way around to get that cash. So it is a delay in receiving our cash. So it is a liquidity risk. Whenever customer does not pay for more than 90 days, we hardly get bad loans back. So that is called credit risk. 1 or 2 days or 5 days, 1 month delay, but they are paying. That is not credit risk, that is liquidity risk. The obligo, when the bank consider the obligo will not pay in full as agreed, it is credit risk. Slight delays and paying, that is not credit risk, it is liquidity risk. Or obligo is more than 90 days in arrears, then we talk about credit risk. Right? Then that is from the individual loan side default risk. The person is not paying. Then we have concentration risk. The risk associated with single exposure or group of exposures, related though unrelated, with potential to produce large enough loss to threaten the bank's cooperation. It is the single or group of exposures. It can be related or unrelated, with the potential to produce large enough loss to threaten bank's cooperation. Right? Hope you can hear me. It's raining here. Right? Large enough loss. What do you mean by that? Think of your own branch. We have a 1 billion turn asset. Out of this 1 billion, 3 main businessmen in the town counts for 400 billion. So these 4 people are your gods. Why? If they go out, your entire performance will drop. If they don't pay, your NPL will go up drastically, one shot. So you have to manage them very, very carefully. Right? Whatever they ask, you will have to accommodate. That is called concentration. But if your 1 billion has been created with large number of small loans, the largest loan is 2 million rupees. So 1 or 2 people going bad, you don't bother. There will not be a big hit. Right? So we don't have a concentration risk in the second portfolio. No large ticket size, no large exposures. So everyone is almost the same. It continues. Single exposure. Then we talk about group of exposures, related though unrelated. Think about this. We have a branch where you have 1 billion turnover. There are 5-6 companies owned by same people, group of companies. That accounts for different individual companies, but it is into one group. One shareholding structure, one subsidiaries of a holding company, like that. Then if this group goes bad, we have an issue. So group of exposure related, interrelated companies. Right? One big family, brother, sister, brother-in-law, all companies together, also larger portion. So it is related risk. Unrelated. Think about Nigambu branch. 2 billion exposure. 1.5 billion to tourism industry. What is the current situation? No tourism. Right? So therefore it get affected. Okay. So it is unrelated. It can be related. It is owners are unrelated but in same industry. So this concentration risk can be due to single exposure or name concentration, that is few people, or sector concentration, that is tourism sector, tea sector, transport sector, all those things, import sector, export sector, like that, we can have issues. Like whenever you have high dependency on importers, if when current days we can't honor it, so they take out. They take out their money because bank is not providing dollars. Their short-term loans are not revolving. So it is an effect to the bank. So credit risk comes with two main categories of risk. It is credit default risk or transaction risk and concentration risk. Concentration risk is single or group of exposures with the potential to produce a larger enough loss to the bank's cooperation. Right? It can be sector, it can be industry, it can be geography, anything. Then we go to risk management. Sound practices of managing credit risk. Establish an appropriate credit risk environment. Right? These are the 4 steps we have under this. Establish an appropriate credit risk environment. Operate under sound credit granting process. Maintain an appropriate credit administration, measurement and monitoring process. Ensure adequate control over credit risk. Right? 4 practices are: establish an appropriate credit risk environment, operate under a sound credit granting process, that means credit granting process, maintain appropriate credit administration, this is the administration function, ensure adequate control over credit risk. Right? We'll go to the first one first. Establish an appropriate credit risk environment. Can you remember our first lecture? We spoke about credit policy. We spoke about credit culture. Why I did that? To come to this point. Credit policy, board of who owns it? Board of directors. They approve it. Custodians, integrated risk management department. Board of directors should review credit risk strategy periodically. It can't be 10 years old. No, it has to be reviewed continuously. Then board can approve and in place the risk policy, but the top management, senior management should implement. This is the agency theory. Board approves, the management operates it. Credit risk strategy approved by the board. So we need to have a proper credit culture. How management look at risk is called credit culture. Credit policy, then credit culture, all these embedded in this point. Establish an appropriate credit risk environment. Whether we are going for value-driven culture, whether you are going for market share-driven culture, whether you are going for current profit-driven culture, whether you are going for target-driven culture. Based on that, your credit policy also changes, right? How we look at risk. That's the first one. Then operate under sound credit granting. That is, firstly, we look at the umbrella, top umbrella, which covers the entire credit process. Then we need to have a proper credit granting process. That means we should have a thorough understanding of the borrower, purpose, structure of the credit, and source of repayment. Whenever we are granting a credit, we should understand the borrower, why we are giving the loan, and how we are giving the loan, and how the customer repay. What is his repayment capacity? From where he is getting his money? Those parts we need to understand. We just can't grant a loan blindly. You have to look at these things. You have to be very thorough about the customer. We should know, okay, we are granting this loan and this is going for this purpose. Right? We are giving a term loan, we are giving a short-term loan, we are giving a short-term revolving one, or we are giving a short-term self-liquidating loan. And the source of repayment. How can he repay? What is his current cash flow? Then secondly, it is establish overall credit limit at the level of borrower, individual borrowers, and connected counterparties. That is the concentration risk limit. Right? We have 25% of capital is the single borrower limit. We can put, okay, for industries, we can have only 5% of our capital. 10% of our loan book will not be given to one industry. Like that, we can have established overall credit limits. Then you should have clearly established process for approving new credit and extension of the existing credit. That means you should have proper DLA, proper reviews, proper people to approve. That is DLA, third line. Fourth one is arm's length basis. Ate during Australia here on the same thing here. You should not cross the Lakshman Rekha. And that means you should not be very friendly, or you should not go to customer score. Then you can't say no to a customer whenever you have a very close relationship with a customer. You need to have a close relationship, but it should not be a personal relationship. It should be always a professional relationship only. You should be able to say no to a customer at any given time. We say, if a customer gives you a glass of water, they will take a bowl of water from our mouth. That is the danger of credit. So always you should know the limit between the customer and the credit officer. So thorough understanding of the borrower purpose, structure, source of repayment, overall credit limits, process for approving new credit, and arm's length lending. That is the second point. Operate under sound credit granting. Third point is maintain a credit administration and measurement process. Credit admin, right? Implement, you can grant a loan, assess, plan policies, you need to have proper policies, then implement and safeguard and monitoring. This is admin part. Have in place a system for ongoing administration of various risk-bearing portfolios. See, we have very good customers whom you don't have to even remind. You give the loan, they will honor the repayment even without your knowledge. So that kind of a customer, if you just review him every year, that would be enough. But there are some other customers who need a regular visit. So these two types of portfolios need to be looked after by different ways. Every month one, you need to visit, you need to take documents, everything you need to do it on a monthly basis. So based on the risk rating, based on the risk category, we discuss about internal risk rating. What is the meaning of risk rating? It is the credit worthiness of a customer. Lower the risk rating, higher would be the credit risk. Higher the risk rating, lower would be the credit risk. Right? So, whatever the treatment you give to your A customer and triple A customer will be different. Right? So, you should have a process to monitor and manage these different risk-bearing portfolios. Then you need to have an internal risk rating system. As we discussed, it is a necessity from the central bank. Each and every customer, borrowing customer of a bank, needs to be risk rated. That is why we can group similar risk category people and have management techniques to control different risk categories. That's the first point, right? Third one, have an information system and analytical technique that enable management to measure credit risk of on and off balance sheet items. What do you mean by on balance sheet and off balance sheet? First day or the second day we discussed. On balance sheet is all cash out facilities. Term loans, credit cards, PODs, housing loans, leases, all the facilities. Off balance sheet facilities are there is no cash out, bank just take a responsibility. LCs, bank guarantees, all those things. Right? So we should have a proper MIS system. Any given time, we should know what is the exposure for LCs, what is the exposure to USA, what is the exposure to Russia, what is our triple A exposure, what is our single A exposure. All those things we need to know. So that is the MIS. Without proper MIS, you can't run a business. Data is the key. You need data to run the business. System for monitoring overall composition and quality of the credit portfolio. That means NPL, PNPL, first bucket, second bucket. So everything should be monitored. When it comes to NPL, you have special mention, substandard, doubtful, loss category, different categories. So you have to monitor those things. Then legal action cases, asset acquisition cases, all those things you have to do. So from the day one of granting loan till we recover everything, you have to monitor. For that, you have to have a system for monitoring overall composition and quality of the credit portfolio. Then consider future changes in economic conditions when assessing individual credit. So always you need to have a buffer. You need to predict the future outlook of the industry, future outlook of the business, right? That also comes under admin function. Then ensure adequate control over credit risk. System of independent ongoing credit reviews. Can you remember? We spoke about CRD, Credit Review Division. Before granting the credit, we have one risk team who looks at the credit and try to put the credit into perspective. Then we have LRM, Loan Review Mechanism. It is a direct nail to the approver's head. They will go through the approval and look at the mistake and try to point it out, so the approver will not continue bad practices, right? So it is a direct nail. So you need to independently review these credit. Credit granting function is properly handled and credit exposures are within limits. That means you should have proper DLAs that should be monitored. Always we have to monitor whether facilities has been granted based on the approved DLA. So limits has to be monitored. If we are crossing any sector limits or individual limits, you have to stop. Then we have to have a system for managing problem credit, that is the recovery and provisioning. Like always, you should have a proper recovery mechanism and provisioning mechanism. Provisioning is allocating part of our profits for unforeseen bad loan. Right? So it is ensure adequate control over. So these are the four. Establish an appropriate credit risk environment. We talk about the credit policy, credit culture, all those things. Operate under sound credit granting process. That means the approval process. Maintain an appropriate credit is the credit administration function. Then you have the ensure adequate control over the credit risk, independent reviews, recoveries, and provisioning. So these are the sound practices for managing credit. When we come to mitigating the credit risk, right? I told you we follow the principle of risk return trade-off. Higher the risk, higher the return. Based on risk, we price the loan. Whenever we give a micro loan, we think of high default. May not be wrong, may not be true on that, but micro we assume to be high risk. Right? Therefore, we consider the higher rate always for micro loans. These twofold, basically small ticket size. So when the rates are low, our income would be very low. So it is not justifiable to grant. The other one is the risk. So when our risk rating, when the customer's risk rating is low, we consider a higher rate. Why? Low risk rate means low credit worthiness. High risk rate, good risk rate is good credit worthiness. Right? So based on the risk, we decide the price. That is called risk-based pricing.
Sir, excuse me.
Yes.
Sir, low risk meaning the high credit worthiness. No, yes, is that correct?
Yeah, low risk means high credit worthiness. The
Okay.
AAA is a high risk rating, right? Okay.
Okay, sir.
Triple A
Got
is
it.
the best risk rating, so low risk there. Uh, Single A, double B, that is low risk rates, high risk there. Okay.
Okay, sir. Got it.
Hope I didn't confuse you. Higher risk rating, that is triple A, that is the best part. So best people will be there. So it is the high credit worthiness. Low risk rating means lower grades where high risk because low credit worthiness. Okay. So based on the risk, we price. Then it is risk-based pricing. So it is a loan purpose, credit rating, loan to value ratio, all we look at when we are deciding the pricing. Then we discuss about covenant. Why are we putting covenant? To maintain the same risk profile. We have two types of covenants, which are positive or affirmative covenants and negative or restrictive covenants. Affirmative covenants are customers can adhere to, we can monitor. Restrictive covenants are we restrict the customer of doing some activities. So periodically reporting of financial condition, it is a affirmative covenant. Refrain from paying dividends is a negative covenant. So always, whenever we see bad signs, we should be able to demand a loan. You settle the loan. Then tightening. When the customers are going bad, you reduce the exposures. You have a short-term facility. When the customer indicates the going bad, it is early warning signal. We try to reduce our exposures from the customer, limit the exposures. Diversification. That is, we should not go into one industry. Our portfolio should be diversified, right? That is to avoid the concentration risk. Mitigating risk. So this we have discussed earlier as well. Sample covenant, loan covenants. Checklist is stringent credit standards for borrowers and the counterparties. Strict portfolio risk management, like stringent credit standard is when we are approving, we have to be very thorough. It is stringent. Strict portfolio risk management, we need to have independent management of our portfolios, looking at risk profiles, changing profiles, monitoring, all those things. Constant focus on changes in economic and others. That's why sometimes they say, don't give loans to this sector. Don't give TODs these days. Don't try to push small ticket loans. Like that, we give based on the economic movements, we have to adjust ourselves. That is risk checklist. So you can go through operation risk is there, right? Reputation risk, market risk, liquidity risk. This is what I talked to you about Northern Rock Bank. Look at this. This bank's major 77% is mortgage-backed loans, 5-year, 10-year loan. Whereas the liquidity came from retail, corporate deposits, and security and bonds. These all were maturing within 3 to 6 months period, whereas this is long period. So this journalist was discussing this position. Customers got afraid that because of this, bank will not be able to pay the deposits. So everyone, basically this part, came to withdraw. not this one, these two came to withdraw. Because of that, 46% bank couldn't bear. Summary risk is part of the lending decision. Sound risk management process is key to avoid financial risk arising from lot of other risks. Organizing include banks should focus lot on risk identification, control, mitigation to have smooth business operation. Risk analysis is very much significant in lending decision. We discussed this one. Right. That comes to the end of risk discussion. Current rates are low. So what would be the remedy in future? Samindri. Remedy for what? Current, like when we have a short, low interest rate scenario, in order to avoid the market risk, your long-term fixed rate portfolio should be backed by long-term liability type. It can be, we say, 10-year fixed rate. So if you have 10-year minor deposits, right? Minor accounts, long tenor deposits. It's not 3 months, 6 months deposit, right? So you should back your fixed rate long-term loans with a similar liability products. Even you can borrow long-term at a low rate, fixed rate. Then you can go for long-term. Instead, you fix your rate, but your funding mechanism is short-term. Then we will run into the market risk. If your if your asset is backed by long-term low-rate funding, you don't have that risk. So since we have a low interest rate regime, to avoid the rate risk, you should have a variable rates. That is the easiest. Okay, today it is low, but if rates changes after 6 months, we change your rate. Right? But customer points of view, it is little risky for them. Bank can pass the risk to the customer. Or you should have a proper long-term funding line to fund this kind of things. Samindra, did I answer you? Okay. Any other questions? That ends our risk discussion. So go through this, and if you have any questions, please ask me first thing next week, because it is very easy for me to tell. But if you are not familiar with risk, then it is little hard to go in. Huh? Ask me next week. So I will start the Basel part, but I am not going to the proper Basel. I will talk about the capital part of the lecture. These are the objective of this part of the lecture. The role of the capital in financial institutions, different type of capital, the key concept and objective behind regulatory capital, definition and mechanism of economic capital, and the Basel 1 and Basel 2. Anyway, we will do the Basel 1 and 2 next week. We will discuss the capital now.
This is just a small identification and idea about Basel. What is Basel? It is a city in Switzerland. BIS, Bank for International Settlement, is the one of the oldest banks. 1930. We call it the central bank of central banks. Foster international monetary and financial cooperation, but they don't have any power to enforce any laws. It's just a regulation body. Then we have IB Fed, International Banking Federation 2004. Banking associates are the members of this organization. This is the main forum to address legislative regulatory work of banking industry. This is the place all the regulations generate. Then we have BCBS, Basel Committee on Banking Supervision. This is the key place on banking supervision issues. Basel 1, 2, 3 all came from this. Basel Committee on Banking Supervision, member countries are represented by central banks or authority with formal responsibility for banking supervision. Objective is to enhance the understanding of supervisory issues and improve the quality of banking supervision. The largest economy, US, is not part of this. They are not following Basel. Right? Their Federal Reserve guidelines is superior to Basel. That's what they say. Basel, all other world need, if you are into international trade, international activities, you need to follow Basel. Right? It is a standard, came out from 1974. Hersat Bank collapse. Hersat Bank is a German bank. They were doing dealings, cross-border dealings. They have opened a LC. They are doing a LC business, US and Berlin, right? But they were small bank doing a larger business. So what happened? German government closed down this bank, right? So when they collected the German currency, but they didn't remit to the US. Therefore, German government had to close this bank down. As a result, that LC was not settled. This is a huge one. Was not settled, so the settlement risk arose. So the banking crisis started there. Therefore, G10 countries, central bank governors came together in Basel, BIS, to discuss regulatory matter. That's how this Basel story starts. Why? All the banks operating in the international arena should be in line. They have to be in the same capacity. If you are small, do small business. If you want to do big business, you have to be bigger. Right? That is the thinking behind it. So when we talk about losses, we talk about three types of losses: expected loss, unexpected loss, and exceptional loss. What do you mean by exceptional loss? Right? That is a tsunami suddenly happens and we don't know the loss. So we are not bothered about that. So it is not a risk. Risk has to be quantifiable. Exceptional losses, it can be a one-off thing. So we are not bothered about it. Right? Expected loss. Whenever we project our turnovers, asset books, similarly, we project the NPL as well. We know that when we grant, there will be a loss, definite loss. So we project that also. In order to cover that NPL, we project the provisioning, right? We discuss about impairment and time-based provisioning. We project the provisioning also. When we allocate profits, you add that part also to your interest rate, right? So you calculate it, you recover it from the future customers. So it is expected. So that is also not a risk accommodated through budgeted provisioning. So expected loss we accommodate through budgeted provisioning. Exceptional loss we don't bother because it is not a risk because we don't know. The unexpected loss, we expect something but it goes beyond. That is the risk, right? That is the risk. Unexpected loss is the risk, right? That has to be managed by our own money. If you are, like you can remember the graph I showed you, banks are financed by TMD, term deposits, CASA, current and savings, money market, term loans, and capital. Capital is your own money, all others are borrowed money, right? If an unexpected thing happen, you can't go to deposit holders and say, we gave a loan, they never paid, so sorry, we can't pay your deposits. You can't go to your lenders and say, sorry, we can't repay the loan, my customers are not paying. So, but you can go to your own shareholders and say, sorry, there was a mistake. We never expected this kind of, we are not going to pay you dividends this year. Right? So, unexpected loss is tackled through capital. We need capital to tackle any unexpected losses. Losses are threefold: expected, unexpected, and exceptional. Expected, tackle through provisioning. Exceptional, we don't bother since we don't have any control. Unexpected, we tackle through capital. Role of capital: absorb larger unexpected losses, protect depositors and other claim holders. That means whenever there is a unexpected loss, we pass it to the shareholders. Capital, not to the deposit holder. Then provide enough confidence to the external investors and rating agencies on financial health. See, out of our 5 C's, we look at capital. Whenever you are going to lend to someone, you look at what is their contribution, what is their own money. Similarly, when we are running a bank, outsiders will look at our own money as well. So we have this: absorb large unexpected losses, protect against deposit claims, and provide enough confidence to the investors. This is the role of capital. Again, the capital adequacy requirement, that means we have a standard. We need to have this much capital. Why? Provide a buffer against bank losses. Any loss occurs, we can pass it to this capital part. Protect creditors in the event of bank fails. So we have to pay the deposit holders, then only the shareholders will be paid. Create disincentive to excessive risk taking. That means Basel came out with capital requirement. I told you, if you are small, do small business. If you are large, you can do larger business. So you need to allocate part of your capital. Always, whenever you are granting a loan, you need to allocate part of capital. That means if capital adequacy ratio is 12, 12%, that means when you are granting 100 rupees, loan, you need to have 12 rupees your own funds and balance 88 rupees you can borrow and lend. That is the meaning of capital adequacy, right? You should have part of your loan always as your fund, balance only you can borrow. You can't just borrow and relay. Then we will become Satviti. What happened? Satviti was taking deposit in one hand, lending on the other hand, giving out money on the other hand. When something goes wrong, there is no his own money, it has to pass to the depositors. Right? Then we have type of capital. Economic capital, EC, or risk capital. An estimate of the level of capital that the firm require to operate its business. Regulatory capital, the capital that the bank is required to hold by the regulator. Earlier, that is the capital we need to run the level of business we operate. But regulator may say, no, you need more than this. That is regulatory capital. Bank capital is the actual capital we have. Okay, this level of operation you need 100 million. Regulator may come and say, no, you need 150 million. But actually I have only I have only 90 million. That is the bank's capital. Then we have three types of capital. Firstly, core capital or tier 1 capital, paid up capital, non-cumulative preference stocks, disclosure reserve, that's the general reserves or profitability reserve. Right? So it is consist of tier 1 capital. Tier 2 capital is general loan loss provision, undisclosed reserves, then subordinated debt, 5-year maturity debt, debentures, and all other preference shares, cumulative preference shares, everything comes to tier 2 or the supplementary capital. So tier 1 capital, tier 2 capital, these are the tier 2 capital, and tier 3 is subordinated debt short term, 2-year maturity short term debt. That is, the tier 2 is 5-year subordinated debts. This is 2-year subordinated debts. Right? So this is the type of capital. So whenever you talk about capital, you have tier 1 capital, tier 2 capital plus tier 3 capital minus deductions. Deductions are you need to deduct goodwill. Right? In our books, we have an amount for goodwill. So you have to deduct that. Then you have to deduct investment in unconsolidated banking and financial subsidiary companies and investment in capital of other banks and financial unconsolidated banking and financial subsidiaries and investment in other bank capital. That has to be deducted because it is linked to capital again. So whenever you talk about capital, capital equals to tier 1 capital, tier 2 capital, tier 3 capital minus deductions. These two are the two deductions we have. Right? Tier 1 is paid up capital, that is the share capital, paid up share capital, non-cumulative preference shares. Right? What is the preference shares? You give preference to these shareholders. Shareholder, like normal shareholder, if profit available only you will get paid. But preference shares, you need to pay after the creditors, you need to pay. And again, the rate you pay is fixed. And if you don't pay this year, you go to accumulate it to second year. Right? So that is preference shares. But here we take non-cumulative preference shares. You don't continue that. If you don't pay, that's it. Disclosure reserve, that's the profitability reserve, P&L reserve. Supplementary or tier 2 capital is general loan loss provision, debentures, subordinated debts, or revaluation reserves. Those are supplementary capital. Tier 3 capital is unsubordinated short-term debt, 2-year subordinated debt. That means if we don't have money, we are not paying. That is the meaning of subordinated. Deductions are investment in unconsolidated banking and finance subsidiaries and investment in the capital of other bank and the goodwill. Right? That is the capital. So from here it is Basel. So I am going to stop the presentation today at this point. If you have any questions, I'm happy to answer you now. Right? If you have any questions, I can answer you now. Next week, I will start with Basel, but I will brush you across with capital again before starting. Any questions? If no questions, thank you.